On the equity side, Chris, I know it's a big question, and again, depending on the fund, but do you look at this by sector? Do you look at this geographically? What's the most savvy way to play it now?
I think you got to look down into the sectors. I mean, the big knock-on effect, right, from the Greek traders, secondary effect. More interesting way to play it is maybe through, the European financial institutions. Who are the big winners and losers in time? France, Germany. The banks, the insurance companies. What are their exposures to it? And there are. I mean, Luke alluded to it earlier, but is everything fully priced in? Certainly we'd say in credit spreads, a lot of financial institutions in Europe, haven't fully priced in a sort of Greek default or knock-on effects of that or exposures to, to that. Similarly, same for the equities. So I think looking onto the knock-on effects, the secondary effects, is really how you have to position yourself, because to us, again, just speculating on the event, on the default itself is difficult. It's just too much uncertainty.
Quick word on the European banks, just in general. Ahead of stress test results, stress tests coming up, of course, I believe next month. Do you sit tight ahead of that?
The stress test just seems to us a little bit to be an exercise in PR. There's not really enough transparency, I think, if you look into the financials, of the banks to actually see what all the exposures are. And generally, lack of transparency to us is probably a sign. It's probably bad news. So the stress tests, we don't put too much into that. The information would be welcome, but I think you have to be cautious. I mean, I think the interesting trades are when you can find cheap options to play on with respect to downside. So whether it's through credit default swaps or with equities, it's harder to find cheap options. But certainly on the credit side, there's some interesting trades.